Hello, you're watching World Talks on TVP World. My name is Sascha Fahrbach. President Donald Trump says U.S. military operations against Iran will continue, quote, until all objectives are achieved, and could last up to 4 weeks. Now, Asian markets opened lower on Monday, with Japan's Nikkei under pressure, and as Brent crude and U.S. oil benchmarks jumped sharply on fears that the escalating conflict in Iran and the wider Middle East has disrupted flows through the Strait of Hormuz, a corridor that carries around 20% of global oil supply. So, how are investors weighing the risk to energy markets and the broader economy? Joining us now to analyze all that is Sławomir Raszewski, Senior Oil and Gas Lecturer, University of London, who joins us now. Good to have you back on TVP World. Let's jump right into it. We have the data from the markets in Asia. They have already shown a lot of loss there. What do you think it's going to play out today now as European markets open up?
Yes, good morning. Well, first of all, this is something which we kind of expected that it's going to happen, but we don't know exactly how long this is going to last, and very much the next few days is going to tell us whether it is a protracted conflict or whether it is going to be a short-lived conflict. But what we are expecting, what we kind of expected happened in Asia. The prices have gone up by 10%, and we're probably going to see less of an impact in Europe, and it's largely because Europe is not as dependent on Iranian oil as Asian markets are. However, as you rightly pointed in the introduction, we're talking about Strait of Hormuz, which is one of the key supply routes for, if you like, outlets for oil from the Middle East and natural gas. And I would say what is probably more problematic is LNG that Europe relies on. And of course, at the moment, there's no information about shutting down of the Straits of Hormuz, but there is, if you like, affected. The supply route is affected from the Gulf, so it's pretty much sort of one-way traffic at the moment, largely because shipping companies are avoiding Strait of Hormuz.
Yeah, on that note, you've said the Strait of Hormuz. I mean, in many cases, two-point question. We already have major announcements by shipping companies, including Maersk, MSC. They're all going to now apparently go round, which adds about, I think, 2 weeks to any sort of supply journey. I mean, in terms of how that's going to impact consumer prices in the short term, how bad could this get with all this ship traffic and shipping lanes extended?
Well, first of all, there is a transactional cost added on top of the price already. And of course, this goes with insurance. The insurers have increased the rates, but on top of that, as you rightly pointed, is the length of the supply. And of course, this will have a knock-on effect going forward on the prices. And let's not forget that it's not just about oil and gas, because we tend to focus on the key commodities because they obviously underpin the global economy and they add up to the inflation. But there are also several other commodities, including fertilizers, that also travel from the region. And this will probably have an effect, particularly now in this time of the year, thinking of the agriculture sector, for instance. So Europe overall is probably going to feel this, should this conflict continue, should this conflict be protracted, in the context of natural gas in particular, I would say.
Mm-hmm. And also, I want to ask about the timing. I mean, this is all very fresh. I mean, markets are just opening in Europe now on Monday. But any kind of volatility, and is it how long is Europe in a state, let's say, where it can adapt to this? There's a buffer here. How long would that really hold until European economies and households start to feel the pinch?
Well, the interesting thing is that we've already seen a lot of pressure on European markets after February 2022 with the invasion of Ukraine, and with limits as to how far you can go with imports from Russia. And as we know, there's a ban on Russian imports starting from next year. And, there are 20th package of sanctions that is targeting LNG supplies. So Europeans have shifted over the past few years to suppliers from elsewhere, particularly from the US and Qatar. So, there's a very peculiar situation now in which European countries are going to be quite substantially impacted should this conflict continue.
And also want to get your expertise on oil, because there was that spike. We heard it earlier, some of the data. The price of Brent crude, it briefly jumped like 13%. That was one of the 4-year highs to about $82. Then it eased to around 77. I mean, tell us why that easing, and is that now through? Is this common? What does that tell us where this is going next?
The market has kind of adjusted to new realities, if you like, over the past few years. And the market, if you like, has already consumed this geopolitical premium. And this has been reflected in the prices. The interesting thing is that there's been a lot of oil in the market, but the prices have remained stable and quite high over the past few years. And it's largely because the market has had kind of adjusted to geopolitical premium. But now, at the moment, we kind of expected the prices are going to go over $80, but now there's kind of a moment for the market to have a deep breath and think what is going to happen next. Now, what is important is that on the 1st of March, OPEC held a virtual meeting, and it kind of try to stabilize or send a positive message to stabilize the market ahead of opening today, committing to increase by over 200,000 barrels of oil per day, with Russia being one of the key those who committed to increases of oil production over the next month. Now, OPEC is probably going to meet again to help stabilize the market. But what we also see here is that to the rescue come countries like, plus countries, not OPEC, just OPEC, but also the plus countries, including Russia. So this situation is probably going to be, in a sense, of interest to oil and gas producers. While the supply may be affected, the prices are likely to increase, and this is probably going to be the benefits of oil producers.
Yeah, on that note, I wanted to dig into that, because if we say that decision, the OPEC plus response, we heard on Sunday they're going to be pushing out output, but they're also dealing with the same problem, is that all of that oil has to go through Strait of Hormuz. If it's blocked, if it's damaged, the Russia factor here, I want to expound on that. Tell us a little bit more. Does this now, as we have it, the data we have it, let's say, make more of an appeal again to Russian oil for the world, or how do you see this?
Well, Russia itself does not have the spare capacity to adjust to such dramatic changes. No one does, in fact, So obviously, the worst case scenario is closing down, shutting down the Strait of Hormuz completely, and that would have effect particularly on Asian economies, because let's not forget that the countries of the Middle East are the largest suppliers to China, India, and Asian economies in the first place. But what it shows us is how little has changed in the global energy over the past 30 years. We're still back to square one. Oil is the most important commodity, the most traded commodity, and we all depend on it. Irrespective of all the energy transition debates over the last 2 decades, we still have oil as the most important commodity. And at some point, I mean, this is science fiction because we know what's going to happen, but we can imagine a situation in which alternative supplies would have to come from countries other than the usual suspects from the Gulf. So, Russia would be the one to supply oil. And of course, this is something that probably the policymakers in European Union did not foresee. They did not foresee it coming at the start of March 2026.
Yeah, and let's talk about Europe a little bit more in terms of how this plays out on currencies. If we look at the euro, regional currencies like the Polish zloty, also with the impact, as we already kind of touched on, the IMF warns that any kind of spike in oil prices that could hit inflation. How at risk are currencies, and how much at risk are we potentially now for recession? I mean, some of these economies in Europe were not doing so well.
Obviously, this is purely speculation. We don't know what is going to happen. It may as well just flare and go away within the next week or so. But obviously, there is a potential for inflation, and this the inflation can indeed, with current prices over 10% of what we had last week. If this is protracted, we can see impact on the inflation and the costs. Because let's not forget, oil is fundamental for agriculture, for fertilizers, for transport industry. So protracting conflicts like this one, which affects some important suppliers of oil to global economy, may have impacts.
Yeah, and as you said, I mean, with shipping routes also being rerouted, if we're looking at also skipping the Suez Canal, which other industry, you touched on a couple of them, but which ones in your mind are now most at risk also for coming into Europe?
Well, I think in the European context, the fertilizer industries is affected because, it requires supplies of natural gas. And of course, with limitations when it comes to supply from Russia, the Gulf country, Qatar in particular, and US, of course, US supplies are not affected, but Qatar supplies from Qatar have been the kind of replacement for the Russian volume. So I think this is probably important, particularly now since spring is coming, and of course the agriculture sector is likely to be impacted should this protract.
And then just one last final question. We're dealing with a lot of different data, it's very dynamic, but in terms of worst case scenario, let's say medium case, best scenario, what do you see this whole economic situation next sort of a week from now?
There are two possible scenarios. One scenario is that this will go away, and this is not going to turn into sort of a full-scale invasion and boots on the ground. And indeed, that's what we know from the presidential announcement. U.S. President Donald Trump promised that he's not going to wage new wars like his predecessors. The other option is that we are actually going to see a conflict, a prolonged conflict. So we are kind of in a split mindset now. Which sort of camp we're going to subscribe at this moment? Is this going to be one or the other? We don't know. We don't know because we haven't seen anything like that for a long time. And my gut feeling is that I'm going to be on a positive note, that this is not going to be lasting for long, and probably within the next few weeks, hopefully, this is going to be over. And that's probably the positive scenario. I'm going to stick to this positive thinking camp, if you like.
All right, so we'll see. Obviously, this is going to be a situation that is volatile. The markets don't react well to that, but we will have to see much at play throughout the day as well. Thanks so much for laying out the latest with us. Sławomir Raszewski, thank you very much.
Thanks for having me.
And thank you for watching. That concludes World Talks, but stay right here on TVP World for more. Goodbye.